If you're trading the wheel strategy, there's a big debate. Should you sell call options on Friday to get the additional money from the weekend time decay? Well, that sounds very tempting, but in this video, I will show you why selling calls before expiration can be a huge and very costly mistake. So stay tuned. Okay, so first of all, what is the wheel option strategy? Well, the wheel is an option trading strategy that consists of 3 parts. Number 1, you sell put options and collect premium. Number 2, you might get assigned on expiration date. And number 3, if you are, you sell call options and collect premium. So as you can see, the idea is to collect premium and take advantage of time decay. Now, there's a debate over selling calls before expiration because the question is, can you actually sell calls on expiration Friday before you actually get assigned? Because as an option seller, you're taking advantage of time decay, and holding options over the weekend is definitely working in your favor. So it would make sense to sell the calls as soon as possible. But here's why selling calls before expiration can be a huge mistake. Let me show you a very specific example of a trade that I did. So here we see the chart of Google, and I sold the 108 put options for Google expiring on September 2nd. Now, on Friday, Google traded all over the place. Here's a 5-minute chart of Google. So as you can see, Google traded on this Friday as high as, 110.74 and as low as 107.26. In the last 30 minutes of trading, Google was trading below 108. So it was very likely that I got assigned. So if I wanted to take advantage of time decay, I should actually sell calls against the shares that I will probably own by the end of the day. So let's take a look at an options chain here. So here we see the option chain, and if I would sell the 108 call of Google, I would get $1.72 for them. And that's $172 per option. Based on my account size, I would trade 12 options. So that's 12 times 172, that's $2,064. Very tempting, isn't it? But here's the problem. The closing price of the option on expiration date doesn't matter. Now let me explain. Typically, a broker exercises an option automatically when it is at least 1 cent in the money. So I sold a put, and whoever bought the put had now a put in the money. So the broker would exercise it automatically, but the options buyer can actually send a so-called do not exercise request to the broker. And here's the website of FINRA. So as you can see, according to FINRA, option holders who hold expiring options have until 5:30 p.m. Eastern Time on the day of expiration to make a final exercise decision to exercise or not the options. Now, the markets close at 4 p.m. Eastern Time, so option holders still have 90 minutes after the close to decide whether they want to exercise the option or not. Now again, each broker has different cutoff times for these requests. Take a look at this. As an example, Tastyworks only gives you until 30 minutes after the close. And Robinhood gives you, if you zoom down here and zoom in, you see that Robinhood gives you until 5 p.m. That's 60 minutes after the close. Long story short, even if the option closes in the money, you don't know whether you will get assigned or not. So why is it so bad to sell calls even if you don't own the shares? Now let's talk about the normal scenario. You actually own the shares and sell calls against it. So in my example, I would get assigned at 108, right? I would then sell calls against my existing shares for around $1.70 per call. And if Google closes above 108 on expiration date, my shares are getting called away. So I'm not making any money on the shares, but I can collect around $2,000 in premium. That's not bad at all. Now here's what could happen when you sell calls early. Let's say that you sell the calls against the shares that you don't own yet for $1.70. And now let's say the trader who bought the puts from you chooses not to exercise the option. So now you don't own the shares. Let's say the markets or Google get some news over the weekend, and on Monday morning, the stock opens 3% higher at right here, only 111.20. let's say. That's very possible. You see, trust me, a 3% jump for Google is nothing. So since you sold the call, you're obligated to sell 100 shares of Google at 108 for each option that you own. So you would lose $111.20 minus 108. So that is $3.20 per share. Times 100, that's $320 per option. Now, for my account size, that would be 12 options times $325. So that's $3,900 that I would lose over the weekend. Ouch! And if you don't close the trade right away, it could get even worse. So how to avoid this costly mistake? Well, there's only one way to avoid this costly mistake, and that is don't sell calls before you are assigned. Instead, wait until Monday morning to sell calls, because your broker will let you know on Saturday whether you got assigned or not. And that's exactly what I'm doing. I'm waiting until I know for sure that I own the shares before I sell the calls. So on Monday morning, I now have multiple choices. I can sell calls at the price I was assigned, in this case 108, or I can choose one or two strike prices above my assignment price. So what is the best strike price when selling options? Well, I did a video in which I explain this in detail and show you some more real-life examples. So the video should be popping up right here somewhere. Check out this video, because when you choose the wrong strike price, you might leave a lot of money on the table. So check it out, and I'll see you over there.